Hello, everyone. Again, welcome to another great video where we're going to be analyzing companies that you have requested for us. I'm Moeed Amin with my colleague Ted Wainman, and today we have another clean energy business to look at for you. So there's been a lot of requests about these companies, but before we get into that, don't forget to like, share, subscribe. And look, if you have a company that you are considering investing in, or you're thinking about doing business with them, you're a salesperson, etc., do leave us a note in the comment section about that company, and we will analyze it for you. So let's get right to it. So today we're looking at Active Energy Group, and they're a company that's listed on the UK Stock Exchange, but a lot of their business, in fact, it looks like all of their business is related in the USA market. So just to give you an idea of what Active Energy Group do, there's some great information about this business. So as I said, renewable energy, they're focused on biomass products. So basically they develop biomass fuels from what they say is sustainable resources. Now those sustainable resources come from waste material from lumber operations. So if you think about the forestry activities, there'll be a lot of wood chips, a lot of waste that actually, if normally would have been left on the ground to rot. So what Active Energy Group do is that they collect that waste material, use their technology to then create what they call is coal switch. And coal switch are basically the pellets that they create, which they then use as, they then sell as an energy resource. So sustainable energy. And what's interesting about this company is that they have floated since October 1997. So I'll talk about that in a second. But firstly, we need to thank one of our viewers for recommending or requesting this particular company. So TPD Investing, thank you for your request. Here is your video for you. Now stick around, because there are also two other companies that we analyzed previously where you can start to look at our analysis and start to draw some similarities, some sort of themes, some comparisons, which will help you in your investment thesis. Now, what we'll talk about later on is the massive drop in stock value that we have seen in this company. So if you were an early investor, that you would have potentially lost out on a lot of money. And we're here to help you see if there's something around their finances that you could have actually uncovered before you made that investment thesis. However, if you're doing it right now, you will get a lot of value here. Something to note, right? So something that Ted and I talk about in these videos. We are not going to go into the potential of the industry, the executives, the structure of the business, the contracts they have. Although we know about that stuff, that is not what we're going to cover here. That is for you to do that extra research to go into your investment thesis. What we're going to be looking at are the fundamental financial analysis, which may seem very rudimentary, but actually can be quite complex, and people find difficulty in doing so. So we're going to help you with that part, but absolutely do your research in the other areas to collect your investment thesis before you make any sort of decision, whether that's investment or sales. So Ted, let's share what we have uncovered about this company, and really kind of figure out why did their stock drop so much, and could their finances give us some reasons for that?
Excellent. Well, good to see you, Moeed. So you're absolutely right. So, of course, the stock has dropped since the valuation. What we're not going to do, though, is go back and look at the numbers back when they floated. We're going to look at the latest set of accounts and see whether, now has the drop created a really cheap company? Is it a buying opportunity or not? So that's really just true. The kind of the focus for what we're going to be looking at. So here are the financials straight from their website, and as you mentioned, there's a lot of information about the strategy and what they're up to and the market and the kind of the product, etc, 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 and we are not going to go through that. So I would encourage any potential investor, if you're undertaking fundamental analysis, exactly as Moeed said, you know, you need to read through that yourself. You don't need me to read through it. What we're going to be doing is looking at the numbers, which, as Moeed pointed out, is a little bit more complicated, and sometimes people struggle to read those numbers. Here we are. So start off with the profit and loss account. Here is the profit and loss account. Now you'll notice that it's in dollars. So they're listed on the London Stock Exchange, but they report it in dollars, as Moeed, you mentioned, because their operations are all in the US. And what jumps out to me, which is quite interesting because it's not obvious unless you kind of just pick it apart, but you'll see the revenue. Okay, these are the sales, pretty much flat. It's about 5% down year on year. But you'll notice in 2019, last year, their gross profit was the same as their sales figure, which means that there was no cost of sales. Whereas this year, they're now making a gross loss on sales of 1.8 million. Okay, and that's only $1.8 million. There's no thousands of dollars or anything. This is actual dollars. So they made sales of 1.8 millions. The cost of sales is about 3 million. You can work that out, giving them a gross loss of $1.1 million. So quite interesting. There's a kind of a big question mark. Why was there no cost of sales in the previous year, and why now they suddenly got this massive cost of sales, which suggests that, you know, effectively what it's saying is that for every dollar they sell, it's costing them $1.62 to actually generate the product that they're selling, which kind of just well, it's not good business. You know that as well as I do, Moeed. It doesn't take a rocket scientist to work that one out. So there's our first kind of our first big question. We then come on to this number here, and we see that there is a massive impairment charge. So this is $5 million of impairment. Now, an impairment is effectively a big write down in the value of an asset. So we talk about depreciation and amortization, which is kind of writing off the value of an asset over its useful economic life. An impairment is when you drop your phone down the loo, for example. You would impair that phone because effectively it's gone from £1,000 phone to kaput. So let's just have a go and look at note 4 that tells us about what that number actually relates to. And here we are at note 4, and note 4 tells us that it is an impairment charge of an intangible asset, and it doesn't really tell us anything more about that. So we can go and find the intangible assets note and see if that gives us any more information. And here we are at the intangible assets note. So you can see here, this is note 10, the intangible assets. And we can see this impairment charge. There it is. It's coming through, and it relates to timber licenses. So these guys, they bought the license. If you buy a license, you can't touch the license. It's a piece of paper. So it's an intangible asset. So if you buy, for example, and you'll see licenses typically on telco balance sheets, for example, they buy a 3G license, the right to run a 3 or 4G or 5G network for the next 10 years. They amortize it over the life of the license. So these guys have bought a license. Suddenly it's not worth anything, and therefore they've had to impair it effectively to write it off. And there's a little note down the bottom here that talks about you know, one of the reasons for that effectively that write-off. Okay, so there's here we go. So the timber licenses, and it talks about the you know, the reason for the write down there. Anyway, the point is, you know, they've got a license. It doesn't affect their cash flow, but they've got a license. It's no longer worth what they thought it was, and so they have had to write it down. Let's go back to the profit and loss account. So the rest of the profit and loss account, relatively straightforward. There's the admin expenses. So this is the cost of running the business, 1.7 million, down from 2.8 million. So they're cutting costs, which is good. You'll notice here then they've got a lot of finance costs. So they're operating at a loss, 7.6 million. The underlying operating loss, you could effectively take out that impairment charge. So it's still losing whatever that is, about 3 million. And then they've got these financing costs. If you've got financing costs, it means you've got a lot of debt sitting on the balance sheet. So, you know, interesting that a loss-making company has a lot of debt. It doesn't look too good, and therefore we end up with a loss of $8.8 million. So this is not really filling me with a lot of confidence right now. So let's go down and look at the balance sheet and see the strength of the company in terms of the balance sheet. So what we've got here, we're really looking at the group rather than the company. We're comparing last year to this year. We noticed that so the non-current assets, these are the things we need to run the business. Lots of those intangibles. So those are the kind of the licenses, for example, and then they've got about 10 million of property, plant and equipment. That 10 million of property, plant and equipment, they have borrowed the money in order to fund that. So you can see 22 million of loans sitting on their balance sheet. That's a lot of loans. That's a lot of debt to be sitting on the balance sheet. So you can see that they've borrowed 22 million and used it to buy 10 million worth of assets, and the other 10 million effectively has gone up in smoke. Not looking too good. Here are their current assets. And you'll notice in their current assets, a big number here, they've got about £1 million, $1 million in cash. Even so, the current assets are not sufficient to cover the current liabilities. So here we see the trade and other payables. They owe 2 million to their suppliers. They've got a total of 1.5 million either as cash or coming in as cash soon. They're not really making any sales at all. The sales they're making are at a loss. You know, they're not going to survive. They're, you know, they're in squeaky bum time. They need funding. Let's look down the bottom. We see in the equity side. So here is the share capital and the share premium accounts. So this is all the money that they've been raising, and you can see that they've lost $50 million. Okay, so in effect, there's the debt. This is the equity that they've raised. They've added those two together, and they've managed to lose, you know, effectively most of it, and the balance sheet is now negative. So if you close this company down, effectively, you, the shareholders, are not going to get, you're not even going to get a penny, and the borrowers are probably not going to get their money back either. So not looking too good, and you suddenly think, just looking at this, you suddenly think, hold on a sec, this is definitely not looking good. I want to check that the auditors have picked this one up. So let's just jump up to the audit report, and usually we skirt over the audit report, but in this case I think we might just go in and look at the audit report. And as we'd expect, here we go: material uncertainty relating to going concern. Material means it's significant, and a going concern means, can the company continue to trade? And basically, it just says note 1, which we'll look at in a minute, explains that the group is dependent upon further fundraising to commercialize or develop its core business. So basically, they've got to raise some more debt or equity, and if they can't do that, then they're not going to be able to pay their bills on time, and therefore, effectively, the company is kaput. So very, very high risk. Let's just go and look at note 1 and see what the directors say about this. And note 1 is on page 46. So here we go. Page 46, the directors give careful consideration to the appropriateness of the going concern. So you may know, Moeed, that it's actually illegal for a director to trade, for a company to trade, if it is no longer a going concern. So they'll have the lawyers sitting beside them when they actually put this together, and they say that, we believe it is reasonable to assume that we are a going concern. And you'll notice here they talk about in February 2021 how they have issued some by securing conversion redemption on CLNs, which are convertible loan notes. So raising 7 million pounds in terms of construction. So they're confident that they can carry on raising money in the market. Obviously, if the market turns sour and just says no, we've had enough, then it is going to be game over. So just back at the balance sheet, couple of other things to notice is again, sort of some funny numbers here. So there was no inventory last year, but they've got inventory this year. The trade and other receivables is down significantly. Trade and other payables is pretty much flat. As we mentioned, lots and lots of debt, and that debt is expensive, and the balance sheet has gone negative. Let's go and have a look at the cash flow statement and see what is going on there. So movement in equity, they're not paying out any dividends for obvious reasons. Here's the cash flow. So we noticed that while last year they were generating positive cash, that's this number here, this year they are basically, it's negative cash. And the reconciliation between the profit and loss account and the cash flow is this note 25. So we'll just go and have a quick look at note 25 to make sure that we understand the difference between the accounting loss and the cash loss. So here is the note 25. There's the accounting loss that was from the profit and loss account. There's the impairment. Obviously, the impairment affects your profit and loss account, but it doesn't affect your cash. It's just an accounting entry. So we add that back in. We're adding back the finance expenses. They'll come out a little bit later on. Depreciation and amortization, nothing else to really kind of mention. We see a little bit of movement in working capital going on, and there is the cash loss. So $1.3 million of cash loss compared with an actual cash profit in the previous year. Let's go back to the cash flow statement then. So looking through the cash flow statement, here is the so net cash from the outflow. So net cash from investing. So they're buying intangible assets and property, plant, and equipment. This is a company which is, it's investing. It's still investing. And then the financing is quite interesting. So here we've got the issue of share capital. You'll also notice there's the issue of CLNs, which is these convertible loan notes that's going on each year. So in effect, the debt, that $22 million of debt, that is a convertible loan note, which means that somebody has lent them the money and they said, if you get into problems and the company goes bust, I'm going to be at the front of the queue asking for my money back. And they're probably not going to get it all back, but they'll certainly take a haircut on it. But they are, they're going to be first in the queue. And then they say that, but if you strike gold, if your business model works, if you return to profitability, if it all goes really well, I get the option to turn that debt into equity, and therefore I get the kind of. So this is kind of a convertible loan note is a little bit kind of have your cake and eat it kind of scenario. So if you're an existing shareholder, if you buy a share in this business, you sit behind the convertible loan notes if it goes bust, but you are diluted if the company does very well. In effect, they're gonna the people with the convertible loan notes will convert them into equity. So again, it's worth bearing that in mind. You'll notice here the previous year there was an unsecured debt repaid, and so the unsecured debt was effectively converted into a convertible loan note. So they raised money on convertible loan notes and used it to pay down that unsecured debt. More convertible loan notes, and that's really just, as I said, it's people investing in the company but trying to de-risk that investment. So if you or I buy a share on the stock market, we're taking on a significant amount of risk. And we see that, effectively these financing, this is how the company is financing itself. This is what they're using in order to finance the business. 3.3 million raised, and the question is whether they can carry on doing that into the future. So I think that's pretty much the that's pretty much the financial. So our summary is that it's a funny old business. They're making a loss. They're not generating any cash. They've got a weak balance sheet. They're dependent on being able to raise additional capital on the market. Let's go and look at their share price. So here is the share price since they floated. You're absolutely right. If you'd made this investment here, if you'd got out here, you'd have made a bit of money. But if you got in here and you'd held on for the long term on the basis that you're going to make money at some point, you'd be sitting on a very, very substantial loss. And we see that effectively. So some really good news going on right early. Sort of in around the 2000s, maybe that's a kind of the dot-com boom, and these guys rode the wave, and then it has just kind of it's completely plummeted. So let's zoom in on the kind of the more recent period. So this is obviously the maximum. If we look at the last 6 months, again, it's just been going downwards. It's got a market cap of 25 million. So 25 million, that is, well, there's a negative PE ratio because it's making a loss. The balance sheet is negative, so it's kind of, you pay 25 million for something that's worth negative 6 million. That means that you're paying 32 million more than it's worth effectively, which kind of seems crazy. The only multiple we can use is they do have some sales. It's 14 times sales, if that's of any use to you at all. I'm not sure it is. So any valuation metric, I think we're going to struggle on this one. My conclusion, it's not for me. I tell you what, Moeed, this is not for widows and orphans. You've got to have balls of steel to get in on this one. I'm not saying you can't make money, and I'm not saying that it's a great company and they're right on the cusp of producing this this wonderful kind of product. But I don't know I don't know the product. I don't know the management team. I don't know the industry. I don't know the pipeline. I don't know the contracts they have, etc., etc. So based on these numbers, yeah, count me out.
Yeah, and just to give some context, 14 times sales for an energy company is high. So it's high, and it's based upon very rocky financial foundation. So I agree. And when you're thinking about, in principle, it sounds like it would make sense, right? Forestry, there's a lot of waste from it. It sounds like a good story in terms of sustainable energy, but it doesn't seem to be working out, and it looks like they have less than 1 year of cash runway as well. So anyone watching this as well, the other thing you want to look at is in the director's notes, there is a mention in there about uncertainty in relation to the coal switch product, right? So have a look a bit more in detail around that. I don't want to share more about that. That's for you to look at, but just suffice to say, coal switch is the very product for their existence. It's their competitive advantage. It's what they do. So if there's uncertainty around that, you really, really want to look into that, right? So love to hear thoughts from anyone who is far knowledgeable than we are, right? So we are knowledgeable in the clean energy industry, but we're definitely not experts. So if there's an expert out there watching this, we'd love to hear from you around what your thoughts are in relation to the technology, in relation to the business model, etc. But this was hopefully useful for all of you. Again, like, share, subscribe. Now, there are 2 videos that I really want you to look at that are in relation to this industry, and it will give you a lot more of a context comparison, bit of a theme going on. So the first video is AFC Energy, which we looked into a few weeks ago. So have a look at that video. And the second video is Powerhouse Energy. Again, another clean tech business in a slightly different product model, but both of those businesses, along with this analysis, will give you a very good theme that will hopefully help you in your investment thesis and any sales process that you're going through. So Ted, thank you again. This was hopefully a very, very valuable business to look at, and the analysis. Take care. We'll see you all in the next video.
Good to see you, Moeed.